If you're in the market to buy a home, you might already know that one of the biggest obstacles that people face when buying their first home is saving up enough money for that purchase. I'm going to show you different loan programs, the down payments required for each, and most importantly, a way to get that down payment covered with money that's not even yours. Today, we're going to talk about things such as what is a down payment and where does that come from? How much money is needed for a down payment? Types of mortgages and the minimum down payment for each, and then, as I said, down payment assistance programs, and most importantly, how to find them. So what is a down payment? The down payment are the funds that you're going to put toward the home purchase prior to closing on it. This can be money from your checking, your savings, your retirement account. It can be a gift from a family member. In most cases, you're going to give an initial deposit toward the purchase, followed by the remainder of whatever the minimum down payment required for the type of loan you're obtaining might be. And this could vary whether you're getting a conventional mortgage, an FHA mortgage, a VA mortgage, or really any other type of mortgage, as each has a different minimum down payment requirement for the purchase. An example, on a $400,000 purchase, if you're borrowing $350,000, your down payment is $50,000, which is the difference between the purchase price of $400,000 and the loan amount of $350,000. As I mentioned, the funds can come from a checking or savings account, a retirement account. Now, a lot of retirement accounts allow you to pull that money out as a hardship withdrawal if you're a first-time home buyer to use specifically for a down payment. The alternative to truly pulling the funds out of the retirement account would be to take a loan against your retirement account and pay yourself back the interest. The cool thing about taking a loan against your retirement account is that unlike other types of loans that we as lenders have to count against you, we actually don't count the payment on a loan from your 401k against you because, as I said, you're paying yourself back that interest. You can also get a gift if you have a family member or a close friend that's willing to give you the money for the purchase without expecting repayment of those funds. And what we'll talk about later on in this video is DPA programs. Those are down payment assistance programs. Now, let's start with how much money is needed for a down payment. Now, as I mentioned already, this is going to vary depending on the type of loan that you're obtaining. This number can range from $0 and up. Now, $0 would be for a veteran who's obtaining a VA mortgage. Most other loans don't allow for no money down. They're going to require some sort of down payment from you. Here's an example using a 3% down payment. You have a $400,000 purchase putting down 3%. 3% of $400,000 is $12,000. That means that your down payment on a $400,000 home, if you're borrowing 97% of the purchase price, that means putting 3% down, would be $12,000. That's your down payment. That doesn't factor in any other costs that might come along with the home purchase. We're specifically focusing on what you need to put down because that's required to come from you through one of the forms that I said before: checking, savings, retirement, gift, or down payment assistance program. Now, there's different types of mortgages that you can obtain as a first-time home buyer, or any buyer for that matter. We're going to talk about the most common and, most importantly, the minimum down payment required for each. You can always put more than what I'm referencing, but this is just the minimum to get into the home as far as the down payment is concerned. So we'll start with the conventional mortgage. Conventional mortgage, most people think requires 20% down. They might have been told that by a family member or a friend. That's just what they tend to think is a requirement, when it's typically not the case. You can put as little as 3% down when you're buying your first home, meaning that you have not owned a home in the last 3 years. So as a first-time home buyer, in that definition, you can put as little as 3% down on your first home purchase. Now, there are programs that would require you to, or don't require you to be a first-time home buyer that still allow you to put just 3% down, but those programs have income limits based on whatever the area median income is for where you're looking to purchase. The most common programs that allow for 3% down without being a first-time home buyer are Fannie Mae's Home Ready program and Freddie Mac's Home Possible program. Now, I'm going to show you how to actually look these programs up so you can determine whether or not you meet the criteria for the income to qualify for one of these programs. And as I said, you can do 3% down without being a first-time homebuyer, but I want to be clear, they're also available for first-time homebuyers. So the benefit to these programs is that you get a reduced interest rate and you save money on the monthly mortgage insurance that's required anytime you're putting less than 20% down using a conventional mortgage. So what's cool about this website is you can go in and you can find a link in our description below so you can check this out for yourself. But you can go in, you can find the state where you're looking to purchase. It's available in all 50 states. And you can actually search by city and county. And when you get onto the site, you're going to see different income limits listed. It's going to show you what 100% of the area median income would be. And just below that, it's going to show you 80% of the area median income. That 80% is what you want to focus on for these specific programs that allow for the reduced interest rate, reduced mortgage insurance, and don't require you to be a first-time home buyer to put 3% down. The 100% area median income is something that you should look at as well if you are a true first-time home buyer, meaning you have not owned in the last 3 years, because if your income falls within that 100% range, you too will receive reduced interest rates and reduced mortgage insurance on your home. So check that website out. Like I said, there's a link in the description below. Next thing we want to look at are FHA mortgages. FHA mortgages, as many think, are only available to first-time home buyers, but that's simply not the case. FHA stands for Federal Housing Administration, and they're a government entity that provides these types of mortgages for home buyers looking to purchase a primary residence. Now, you do not have to be a first-time home buyer. Someone who's buying a primary residence is someone who's buying a property they plan to live in year-round. That's the caveat. You need to plan to live in the property all year. If you do plan to live in a property all year, you'd be eligible for an FHA mortgage. An FHA mortgage allows for as little as 3.5% down. So a slightly higher than the conventional mortgage that required 3% down as a first-time buyer. This program, FHA, you don't have to be a first-time home buyer, and it requires slightly higher amount down. So why would someone go with an FHA mortgage over a conventional mortgage? Well, it's a great question. FHA mortgages are more lenient when it comes to credit. So they allow for credit scores as low as 500, where conventional mortgages requires a credit score of at least 620. Now, let me just touch on that briefly. If you're below a 580 getting an FHA mortgage, you'd actually have to put at least 10% down to qualify. If you're looking to go with the lowest down payment option using an FHA mortgage, you're going to want to have at least a 580 credit score to be able to do that 3.5% down payment. Now, these types of loans are available on 1, 2, 3, and 4 unit properties. The same goes for the conventional mortgages. You can buy anything between a 1 unit to a 4-plex when you're using these types of mortgages. And you can buy those types of properties as your first home. The cool thing about those programs is that you can actually use rent from the accessory units to offset the payment on your new property. So if you want to learn more about something like that, you're interested in multifamily financing or house hacking, check out some of my other videos to get into more detail on multifamily property financing and how to utilize that to become both a homeowner and investor all in one. Now, an alternative to FHA and conventional financing is VA financing. Now, the thing with VA financing that's different than these other two types of mortgages is that it's only available to a specific group of people. That's military veterans, active duty military, or the widow or widower of a deceased military member. Now, these programs allow for no money down, which is awesome, right? 0 down. On top of that, there's no monthly mortgage insurance required. So I mentioned that when you put less than 20% down on a conventional mortgage, you have to pay mortgage insurance. With FHA, you're going to pay mortgage insurance regardless of how much your down payment is if you're getting an FHA loan. With VA, there's no mortgage insurance. So you're going to have a lower monthly payment even if you have the same interest rate when you're obtaining a VA mortgage over FHA or conventional. VA loans require at least a 600 credit score. They're also available on 1 to 4 unit properties, and they're only available, like FHA, on a primary residence. right? So you have to plan to live in the property year-round to utilize a VA mortgage. Now, I wanted to touch on one other thing when it comes to the FHA financing. I know I mentioned you can put as little as 3.5% down, and that's with a traditional FHA mortgage. But there are actually some FHA mortgages that allow you to put as little as $100 down on a home. That's it, just $100, not 3.5% plus 100. I'm talking about $100. Now, these are homes that need to be owned by HUD. So I mentioned HUD is a government entity. Now you can check these out on the HUD home store. And I'll put a link to this website as well in the description below. But if you go onto the HUD home store website, which is a government website, you can look at homes that are owned by HUD. And it's available in all 50 states, just like when you want to look up Home Ready and Home Possible. But what you're going to want to do is you want to hone in on the state where you're looking to purchase. So just to keep it simple, I'm in Florida. Let's say I want to purchase a home in Florida. It says there's 35 properties available at the HUD home store to purchase in the state of Florida. And I can scroll through and see if there's any in the city where I'm looking to purchase. Maybe you're not picky and you can live anywhere in Florida. You work remote, so you have the ability to do that. Or maybe you want to get more specific. So you can scroll through, see what's available in your state, in the city where you're hoping to be. And if there's something that meets your criteria, you can actually bid on these properties. And you're going to go ahead and it's going to be an auction style purchase. So you're not guaranteed to get the home unless you win the auction. But assuming you do win the auction, you're able to put just $100 down on the property and finance the rest. So it's a great way to get into a property with almost no money out of pocket when it comes to the down payment. As I said before, you're still going to have other costs involved. Like when you're purchasing a home, you still pay closing costs. However, the down payment itself would only be $100, which nearly anyone who's looking to purchase a home likely has $100 to their name that they can use toward the home purchase. Now, let's get into more detail on the specific types of loans, and I'm going to show you the minimum down payment for each and the amount you should expect. So, conventional mortgage. I said that the minimum down on a conventional mortgage would be 3%. So, as an example, 3% of $400,000 is $12,000. That means that if you were to purchase a home for $400,000, put down the minimum 3% on that home, you would need at minimum $12,000 for that purchase. FHA. If you were to do an FHA mortgage and you were going to put down 3.5%, the minimum on an FHA, $14,000 is 3.5% of the same $400,000. That means you need $14,000 for that purchase. Now, as I showed you, if you buy a home through the HUD home store, you can put as little as $100 down on that same home, but that has to be a home that's listed on the home HUD store. Next, we have VA. VA, we said zero down if you're a veteran, active duty, widower or widower of a deceased military member. So you can put zero down. We know that 0%, or I'd hope we know that 0% of $400,000 would be $0 down. Doesn't get much better than that option. Now, what happens if you don't have the funds for a down payment? Well, there needs to be some option there, right? So that's where DPA, or down payment assistance programs, come into play. A down payment assistance program is exactly that. It's a program that assists with giving you funds to cover the down payment. So it would cover the 3% in the instance of a conventional mortgage. It would cover the 3.5% on the FHA. And when it comes to VA, you can still use these programs, and that money would actually go toward your closing costs since you don't need a down payment. You can still utilize it to put a down payment because 0% down on VA is the minimum. If you get a 5% down payment assistance program and you want to put some of that toward a down payment so you can build some equity in the property, by all means you can do that. However, you can utilize it toward your closing costs as well, since a down payment is not required on a VA loan. Now, what does this do? It's going to cover the funds needed for the down payment on your home. Now, the thing with down payment assistance programs is they're primarily available to first-time home buyers. They're not used for second homes and investment properties. They're strictly for first-time home buyers, 99.9% of the time. There's different types available. They're typically going to have requirements based around your income, credit score, and occupancy. So as I mentioned, if they're for first-time home buyers, they're going to be for primary residences, which means they're going to have occupancy restrictions. And they're either offered through the government or a private entity, like a nonprofit in most cases. Now, What are the common types of down payment assistance? Well, for one, there's monthly payment down payment assistance programs. A monthly payment down payment assistance program requires you to make monthly payments toward whatever amount of money you receive as down payment. There's deferred payment down payment assistance programs. A deferred payment down payment assistance program is something where you don't have a monthly payment, but you would be required to pay that money back at some time in the future. And then there's forgivable down payment assistance programs, which in my opinion are the best down payment assistance programs because they don't require you to pay the money back. They're giving you that money. It's essentially a gift. It does not require repayment. There are caveats to that, and I'll get into those details. Now, let's talk about these programs in a little bit more detail. A monthly payment DPA, so a monthly payment down payment assistance program, does require you to make monthly payments, right? So you're going to have to qualify with whatever the payment might be on the new mortgage, along with whatever the payment would be on these down payment assistance funds that you're receiving. These are typically offered in the form of a second mortgage on the property, right? So you're going to have a lien on the property that needs to be paid off at some time in the future, and you're going to make monthly payments on that. And in most cases, the rate for that lien that you're making payments on is going to be 2% above whatever the interest rate is on your first mortgage. So if you have a first mortgage with an interest rate of 7.5%, that means your interest rate on the down payment assistance loan would be 9.5%, which sounds high, but what you have to keep in mind is it's a very small loan, right? If you bought a $400,000 property and they gave you a 3% down payment assistance loan, that means your down payment assistance loan is $12,000. We're not talking hundreds of thousands of dollars. So although the rate is higher, it's going to have a very low payment in relation to your first payment on the property. It's going to require payments, and it's going to require that you pay the loan off when you hit certain milestones. Essentially, if you were to refinance the first mortgage on the property, if you were to move out of the property and no longer occupy it as your primary residence, or if you were to sell the property. Under those circumstances, you repay, on top of the monthly payments, you repay any remaining balance that's left on your down payment assistance loan. Now, an example of a down payment assistance monthly payment program would be these FHA 100% financing programs that you might see advertised. What's really happening is you're getting a 96.5% FHA mortgage as a first mortgage on the property, and you're getting a 3.5% second mortgage, which is a down payment assistance mortgage or loan on the property, and together those equal 100% of the property's value or purchase price. So you're getting the down payment covered with the loan, but you are going to have to make payments on that loan. So like I said, it's the 3.5% toward the down payment, requires monthly payments. Typically the rate's 2% above the rate on the first mortgage. It's for primary residences. And the good thing about these type of programs or down payment assistance programs specifically is, unlike most others, the FHA, as an example, that allows for 100% financing does not have any income restrictions. Most of these down payment assistance programs cap you based on your household income. This program is a great alternative if you're someone who has a relatively high income, but just doesn't have the funds necessary to make buying a home possible. This is a great option for you. Now, the next option, I would say, is a little bit better than that option, is a deferred payment down payment assistance program. Naturally, what makes this more attractive, in my opinion, is it does not require monthly payments. Once again, it is a second mortgage on the property. However, it's at zero interest, meaning that you're not paying anything on it. It's sitting there. It's attached to the property, but you don't make payments toward it. The only time that you do repay this is when you move out, you refinance, or sell the property. Right? So it requires you to repay it, but that repayment is deferred, right? If you live in the state of Florida, you might be familiar with a program called Hometown Heroes. This is a program that initially came out in July of 2022, was for first responders in most cases, was revamped July of 2023, became available to any first-time buyer who worked for a brick and mortar in the state of Florida. But the big thing with this program is that it covered your down payment and some of your closing costs actually, because it gave you 5% of your first loan amount toward your down payment / closing costs, right? However, what a lot of people didn't realize is this requires repayment. It requires repayment in the circumstances I mentioned. You refinance, you sell, or you move out of the property and no longer occupy it as your primary residence. It's still an awesome program. It allows you to buy a home when you otherwise might not have been able to do so because you couldn't save the funds up. However, it requires repayment. Once again, no monthly payments. It's for first-time home buyers only. It's for a primary residence only, meaning it's a residence you're going to occupy year-round. But there are income and occupancy restrictions, right? If it's only for primary residence, we know that's an occupancy restriction. When it comes to the income levels, there are certain income limits based on the county in which you're looking to purchase. And so it's important to understand that when you're applying for down payment assistance programs, that if it's this specific program, as long as funds are available, you need to make sure that the income that's being used to qualify for the mortgage is under those limits. If you want more information on Hometown Heroes, what those limits are, please go ahead and make a comment. I'll go ahead and I'll answer those in real time for you. I'm reviewing my comments regularly. Now, the last and what I consider to be the best possible down payment assistance available are forgivable down payment assistance programs. These programs do not require repayment at all. They're a second mortgage on the property at 0% interest, but they typically require you to stay in the home for a certain number of years in order for it to not be repayable. Most cases, it's 5 or 10 years. You have to occupy the property. After that period has elapsed, you no longer would have to pay that money back. However, if you did move out, sell, refinance within that window, you would have to repay the funds. So you have to know going into the property, if you're going to use a program like this, you're going to stay in it for at least the period of time that the program requires for you to not have to repay those funds. An example of a forgivable down payment assistance program is the Hallandale Beach First Time Buyer Program. This program gives you up to $50,000 in down payment assistance. You need to occupy the home for at least 10 years. Primary residence, there are income restrictions just like most of these programs, and you need to contribute at least $2,000 of your own funds toward the purchase. So to utilize a forgivable DPA like the Hallandale Beach First Time Homebuyer Program, you do need to come out of pocket with at least $2,000, so you're going to have to save that up. But they'll give you up to $50,000 toward the down payment on your new home, and you do not have to repay that if you stay in home for at least 10 years, which is pretty awesome. You're probably saying to yourself, that's great, these programs exist. How do I find these programs? Well, it's a fantastic question. So Freddie Mac recently released a website called DPA One. Now DPA One, which once again, I'll include a link to this website in the description of this video below. But what this actually allows you to do is do a simplified search for all down payment assistance programs throughout the United States. And as simple as filling in 5 or 6 fields within this website, and it will show you what's available, and you can do comparisons of each. So I'm going to do it for you real quick, just give you a general idea. So let's say, like we said before, I'm in Florida. I'm looking for something with a purchase price, let's make it up. I'm going to call it $400,000. So this seems to be the number we like to use today. So we're going to do $400,000 purchase. My household income, make up a number, $80,000. My annual income, I'm going to say $80,000. And the reason it has 2 different fields for that, annual household income is for anyone who lives in your home added together. Some programs look at household income. This other box, annual qualified income, that's the income for the person applying for the mortgage. You might not put everyone in your household on the mortgage. Your household income might be $100,000, but the person who's trying to qualify for the mortgage might make $50,000. Some programs will base qualification off of household income, while others will base it off true qualifying income for the mortgage. So that's important. You might make too much income as a household, but you might qualify based on your qualifying income for the program, and you might not need the household income to qualify. So it's important that your lender talks to you about these things once you determine the program is available, to better explain how they work and how we can fit you into these programs. Now, credit score, some of these have credit score requirements. Let's say you have a 700 credit score. You're a first-time buyer. Now, I'm going to hit search. Now, it's that simple. It just pulled up all of the programs in the state of Florida that meet that criteria, right? It was a matter of seconds for this to pull this up. Something that would have taken you probably weeks to try to put together, and still, who even knows if you would have been able to do it in that amount of time. It shows you all the programs that are available. If I want, I can click on a couple, do comparisons of each. It tells me what's required. Are there income requirements? Are there household member requirements? So on and so forth. Really, really easy to use. Now, here's another thing. Maybe you're not technologically savvy, right? You don't want to try to use that. As simple as it might seem to me, it might not be easy for you, and I understand that. So there's actually services available. They don't charge to help you with finding these down payment assistance programs. The one that we hear most about is the Housing Foundation of America. You can reach out to them. We can include a link to their website as well below in the description. But there are individuals there that will provide free services to you based around what criteria you're looking for and whether or not you meet it. They'll let you know what programs are available to help you apply for those programs, right? Because it's not just about finding the programs, there's a process in applying for a lot of these programs, which might be cumbersome for someone who's trying to go through the process, which this is typically the first time you'd be doing it. So a service like this one is a great option if you need assistance with applying for the down payment assistance programs and seeing whether or not you qualify for them. Because just to be clear, most of these programs are going to be things that you want to apply for prior to applying for a mortgage. Because if you don't know whether or not you can obtain the funds for your down payment, well, that's going to be a big piece of qualifying for a mortgage, right? Because we're not just looking at income, employment, and credit. We also look at assets, which would be money that's available to use toward the purchase. So if you don't have your own funds and you're going to utilize a down payment assistance program to cover those funds, well, then you want to know whether or not you're eligible for those programs in advance. So if you like this video and you want more information on the home buying process, different products, programs, things going on in the market, make sure to subscribe for more videos like this one or more detailed videos for your specific needs.